Next slide. So this is accounting elements. Now some of you are going to be very familiar with this terminology and how it all works together, and for some people this might be a bit of a review, or maybe hopefully helping you understand a little bit more about how all of this fits together. So you have assets, these are things you own. You have liabilities, these are your bills and loans that you owe, and you have equity. This is the investment in the business. You may have put that money into the business. You may have inherited some of the assets that then become equity in the business. You may have investors. You may have stockholders that have put money into the business and thus have some of that equity. And then you have incomes and you have expenses. We all know what those are. And the list of all of these items creates your chart of accounts. So assets might start with the bank accounts and end with the real estate. Liabilities, again, usually start with the short term. These are maybe some bills that you've gotten behind on, or equipment loan. And then the difference between the assets and the liabilities is your equity. And then since we've started a new year here, the income, that would be revenue you've generated since the first of the year, and expenses you've had in the same time period. Now at the end of the year, so let's say for 2013, you zeroed out or closed the 2013 books, and this converted your profit, that income minus expenses, hopefully if it was positive it was profitable, if not negative, the loss, those then go into equity, and if you leave them there, they become what are called retained earnings. So the chart of accounts is something we're going to be talking about again in just a couple minutes. So let's move to the next slide. So you can change your chart of accounts very easily by adding additional elements, additional categories under all of these elements. So just the accounting equation here on this slide is assets equals liabilities, and liabilities include owner's equity. Owner's equity starts with investment. Equity includes previous periods of time, profit or loss. Equity is reduced by owner draws. Now I feel very strongly, and all the books are going to tell you this, but we see it get messed up a lot. The business books need to be separate from the personal books. The bank accounts need to be separate. Your chart of accounts for the business does not include groceries for the family. This is the business side we're talking about here. In order for you to buy groceries for the family, you might need to draw money out of the business accounts, the farm accounts, and move it over to your personal account or cash the check. And that's fine. That's part of being in business. The owner needs to get paid. And those are owner draws that go, again, over to your personal accounts. Another little equation here, assets equals liabilities plus equity, and profits left in the business or in the farm accounts become retained earnings, also called equity. Next slide. Okay, some of the balance sheets. Again, we're talking a little bit about some terminology here. We're going to have the balance sheet. That's the assets, liabilities, and equity as of a particular point in time. We're going to have profit and loss. I also refer those to as an income and expense statement, and they're definitely very close to IRS Schedule C, which is the business, or Schedule F, which is the farm schedule that it gets attached to your 1040 tax return. So When you set up your chart of accounts or you make changes to your chart of accounts, these are things that might come into consideration. You're also going to have various other accounting reports, possibly including enterprise budgets, depending on how your system is set up and what you're able to pull out. The better your record-keeping system and your chart of accounts, your accounting system, the better that's put together and planned out and thought about, the better information you're going to be able to get out in order to make those good decisions that we're talking about. Next slide. I've already talked about the time factor with the balance sheets being as of a particular point, such as January 1st, and the rest of them all being for a period in time, such as for a year or year to date. Let's go to the next one. So I included an example here that we're going to go into a lot more depth on this next week, but because we've been talking about some of these terms, I just wanted to show you how they all fit together in the report. And the reason this is called the balance sheet is because down on the very bottom, the total liabilities and equity are going to equal the total assets, and that means that it's in balance and hopefully the entries have been made correctly. Next slide. This is the income statement, and we've been talking a lot about gross profit analysis in the first part of this class, and I'm going to move into talking a little bit about net income and enterprise analysis that includes both the variable and fixed expenses. So for my purposes, this cost of goods sold up here is your variable expenses, and the items listed down here as operating expenses, sometimes called overhead, sometimes called variable expenses. Again, there's probably technical differences, but I use those interchangeably. So we get gross profit after deducting the cost of goods sold, and then down here after all these other taxes, expenses and taxes, we get down to net income. And net income is sometimes called the bottom line, and that's the number that makes the big difference in terms of whether or not you are profitable. Next slide. So again, a little bit more about my terminology and use of these terms. Cost of goods sold is variable and direct costs. Indirects, overhead, are all the rest of the expenses that are not in the cost of goods sold. Net income is calculated after all expenses are deducted from revenue. Revenue equals sales, although in some of the examples we look at, interest revenue is down below. And expenses are all the tax deductible expenses that you're including in your tax return. Next slide. So I've set up kind of a step 1, 2, 3 in making your records more useful to you. So to start with, you're going to analyze what information needs you have for your decision making for your farm. So I use an example here. Will you be selling your calves when weaned, or will you be feeding them out? So one of the things you need to know is your cost to get from one stage to the next. What is the value if you sell the calves right when they're weaned versus the prices and the weight gain, what their value is when you sell them after feeding them out. And then you need, so you need to know that value, and you also need to know the cost to get from one stage to the other, and are your records set up to provide you with this information. Next slide. Now, none of us can see into the future. None of us know exactly how much weight gain you're going to have or exactly what the prices are going to be 6 months from now, but we can make projections, and that's what planning is all about. So I want to point out that QuickBooks has a tool that some people are not really familiar with, and it's called classes. And we're going to, you can set up classes and subclasses that will give you additional detail about your operation. So let's say you set up one enterprise as being your crops and you set up another enterprise as being your livestock. If you do use QuickBooks, then you can have subclasses of crops or livestock. For example, somebody talked about sheep and goats and possibly pigs and chickens. So you could have 4 different classes underneath livestock for those 4 different types of livestock. And then you can set up subclasses underneath those that might be things like marketing costs, feed costs, transportation costs, pasture costs, so that you can get that additional detail drilling down for that decision making. On the other hand, a person can get so detailed that they are spending too much time on the books. So let's say you only have 4 chickens. You're not going to be trying to get down into that kind of detail for that small of an enterprise. On the other hand, you don't want the goats to have to pay for the chicken feed either. So these are some types of subclasses or subclasses. Locations. So let's say you have crops that you rent from farmer A, and land that you rent from farmer A and land that you rent from Mr. B. So those might be 2 locations that you're able to divide up the expenses on and determine that, you know what, I'm paying too much rent for Mr. B's place because I cannot get the type of yields out of that I need relative to the expenses. People talk about, I think Diane talked about selling wholesale, selling through CSAs, selling at farmers markets. So how you're marketing the product could be another type of class that you want to keep track of. So for example, if you're growing lettuce, you might figure out that you're making more money selling it to the restaurants than you are selling it at the farmer's market. And I think actually I've probably stolen that example right out of the business handbook. And then the stage of production that we were talking about earlier, whether or not these are weanlings, whether or not you've fed them out, whether or not this is a cow-calf operation, anything like that. And customer type possibly is a way that you can break down your records in these classes. And that tab is in the company preferences tracking tab in QuickBooks. Let's go to the next